Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Chinese economy, and specifically to talk about a very worrying trend in terms of the amount of governmental support for all areas of the economy that's now leading to an increase in debt at the governmental level. Over the past 2.5 years, the Chinese stock market has suffered a dramatic fall. And this was at a time when other markets around the world were buoyant. They were actually hitting record highs. And one of the reasons for that has been the underperformance of the Chinese economy. The growth in the economy has come in at a lower level than was originally expected. And in today's video, I want to pick through the details as to exactly what's been happening with the stock market, because stock markets are a good indicator as to what generally is happening in your economy. If all of the companies that are listed in your country are doing well, if they're over exceeding in terms of their sales and profits, then generally speaking, their share prices will go up. But if they're not doing particularly well, then their share prices will go down. And that's exactly what's been happening in China over the last couple of years. Now, there has actually been a bounce back in the Chinese stock market over the past couple of months. However, the main driver for that has been a huge amount of purchases that have been funded by the Chinese government. And one of the other things that the Chinese government has been doing to try to stimulate the economy is increase the amount of lending that's made available to Chinese businesses. However, research has now been published showing that that lending isn't going to the manufacturing businesses in China, which are the heartbeat of the Chinese economy. And actually, some of that money has been used to invest into financial products rather than doing things that will increase the profitability of those businesses and therefore increase the economy of China overall. So in today's video, we'll go through the details as to what's been happening in the stock market, and we'll have a look at the stimulus that the Chinese government has pushed through the market to try to get it to come back up again. We'll then talk about what's happening with regards to credit, because there's been a fall recently in the total amount of debt that's being taken. And one of the interesting things to look at here is the breakdown of which companies and institutions are actually taking the debt that's been provided by the Chinese government. We'll also talk about a new initiative that's just been launched by the Chinese government, where it wants to raise 1 trillion yuan in long-dated debt. And then finally today, I'll wrap up with my summary as to what I think is likely to happen in China during the course of the rest of 2024 and what this means for the Chinese economy. But before we get started on all of that, I'd like to say once again, thank you so much to everyone that's supporting the channel. If you've signed up as a long-term supporter, either through Patreon or Buy Me a Coffee membership or YouTube membership, thank you for that long-term support. Really helps to keep me motivated, keeps me focused on making more videos to keep you guys entertained. And don't forget, if you do sign up as either a Patreon or a YouTube member, you'll get early access to my videos. And on Patreon, you don't have to watch all of the adverts that are posted constantly on YouTube, because I know that's a bugbear for a lot of people. And if you've sent me a YouTube super thanks or bought me a coffee recently, thank you so much for the time and effort that you've taken to do that. Really appreciate it. Really helps to keep me going. As I mentioned at the start of today's video, a really good indicator as to what's happening in an economy is what's happening with the stock market in that country. Because if all of the companies are performing well and their share price is going up, then the stock market index will be rising. However, if those companies are struggling and their profits are falling, then it's likely that their share prices will also be falling, and so the stock market index will be going down. This chart shows the movement in the Shanghai Stock Exchange Composite Index, which is basically an index of all of the shares listed on the Shanghai Stock Exchange over the past 5 years. And what this chart shows is that in the last 5 years, the high point of the index was achieved at the start of September 2021, when the index hit a peak of 3,711. However, between September 21 and January 24, there was a consistent decline in the index, and it hit a low of 2,709 at the end of January 24, which represents a fall of 27% over that period. And just to put this into context, this chart shows the movement in the S&P 500 in the USA over the same period. And if we look at where the index was in September 21, it was sitting at 4,390. However, today it's at 5,223, which represents an increase over that period of 19%. So the poor performance of the Shanghai Stock Exchange index isn't related to what's happening globally. The long-term fall in the index tells us that on average, over the last 2.5 years, the share price of Chinese businesses has been falling, bringing the index down. And the reason that those share prices have been falling is because of underperformance by the companies themselves. So all of this gives us a strong indication that there have been problems in the Chinese economy because the stock markets don't lie in the long term. Now, if we zoom in and have a look at what's been happening over the last 6 months, you can see that the stock market index hit a low on the 5th of February of 2,700. However, since that time, there's been a remarkable recovery, and the current level of around 3,150 represents an increase of around 17% over the last 3 months. So this potentially indicates that things have started to pick up, that companies are doing very well, and the share prices are now rising rapidly. However, you need to look into the details to make sure that this is a genuine market reaction and not something that's being manipulated. And it's recently been revealed that in the first quarter of 2024, the Chinese state poured $41 billion into stock market purchases to drive up the price of those shares. So you might be sitting there thinking, well, how does that actually work? How does the Chinese government increase the share price of all of these different companies? Well, the way that they do it is by investing into funds, and those funds then use the money that the Chinese government has given them to buy shares in Chinese businesses. And as we all know from simple economics, when there's an increase in demand for anything, it generally drives up the price as long as there's a limited supply. And that's exactly what happens with shares. As all of those funds start buying more and more of the Chinese stocks, the price goes up and therefore the index goes up. And that's why we've seen a remarkable bounce back in the Chinese stock market over the last few months, because the Chinese government is funding the purchase of Chinese shares to bring the index back up. One of the other indicators that gives us a good read as to what's happening in an economy is the level of overseas investment. If your economy is booming, if your consumers are buying things and growing and becoming more wealthy, then that will attract in companies from all around the world. Multinationals will want to go and set up operations there to be able to benefit from your economy. But also, if you're growing in terms of your manufacturing and developing all of your industry, then that also can attract in foreign investment, because companies may want to set up factories and facilities in your country to benefit from things like cheap labour, high productivity, all of those sort of things. So foreign investment into an economy gives us an indication as to whether or not that economy is booming or if it's going into contraction. And this chart shows the level of overseas investment into China over the last 15 years. And the scale on the right-hand side of this chart is shown in billions of US dollars and goes from minus 20 billion at the bottom to plus 120 billion at the top. What this chart shows is that between 2009 and 2011, there was a rapid increase in the level of foreign investment into China, increasing from around $20 billion per quarter to over $75 billion per quarter. Between 2011 and 2015, the level of quarterly investment remained high, averaging around $50 to $60 billion per quarter. The level of investment between 2015 and 2019 reduced slightly, but remained at a healthy level. However, between 2019 and the start of 2022, there was another huge increase in the amount of foreign investment into China, and it peaked in the first quarter of 2022 at around $110 billion. However, in the second and third quarters of 2022, there was a remarkable fall in the level of overseas investment, and it fell to around $15 billion by the third quarter of 2022. That trend continued in 2023, and in the third quarter of 2023, there was actually a net reduction in the amount being invested into China by overseas companies. They actually withdrew investment from the country, over $10 billion in that quarter. And in the first quarter of 2024, the total amount of new investment was $10.3 billion, which, apart from the negative result in the third quarter of 23, is the lowest level of overseas investment in China that's been seen for more than 15 years. And if you look at what's been happening over the last 2 years, you can see that overseas companies are now very cautious about investing into China. And once again, this tells us that there are problems in the economy. As I mentioned at the start of today's video, one of the ways that the Chinese authorities have been trying to stimulate the economy is by increasing the amount of debt that's available to Chinese companies. However, it now looks like that strategy isn't having the desired effect. This chart shows the year-on-year movement in the amount of finance being made available to Chinese companies dating back to 2016. Now, the black section here represents loans that have been made to manufacturing businesses. And as we've discussed before, manufacturing is the heartbeat of the Chinese economy. That's what it's famous for. That's what it does. It sets up these gigafactories, these absolutely enormous factories, and they make millions and millions of different items and then export them all across the world. And the blue section on this chart represents loans made to non-manufacturing businesses. So these are other businesses that are not involved in making anything. And what this chart shows is that between 2016 and 2020, the net increase in loans made available to Chinese companies was relatively modest. However, between 2020 and 2023, there has been a sharp increase in the amount of loans made available to Chinese businesses. And there are a number of interesting things to look at on this chart. The first thing to note is that between 2020 and the end of 2022, the vast majority of the increase in loans was being provided to manufacturing businesses, the black section on this chart. However, over the last 12 months, you can see that the blue section has increased significantly. So a higher number of non-manufacturing businesses have been taking loans from the government. And I'll come on to talk about that in more detail in a moment, because there are now concerns that that money hasn't been invested into growth, it's been invested into financial instruments. And the other thing to note about this chart is that if you look at the far right-hand side, there has now actually been a fall in the level of increase in these loans. And this tells us that companies are now reaching saturation points. They can't actually take on any more debt. There are rules and regulations in China, and also there are cash flow constraints. And when you get to that point, the stimulation that's being put into the economy by the Chinese authorities isn't going to work. RHODIUM, which is an independent research agency, recently published analysis saying that it believes that the large increase in government-backed debt in China over the last 12 to 18 months has been utilised predominantly by local authorities to refinance their debt, by companies that had existing debt that was maturing that they needed to refinance on a cheaper basis, and also by non-manufacturing businesses in China that have been drawing down the debt and using it for financial arbitrage, basically borrowing at cheaper rates than they can earn on the financial market. So essentially taking the money and investing it to make a profit. Now, obviously, none of those three activities will help to generate any additional profit in the Chinese economy. The driving force behind this debt that's been provided by the government is to try to encourage growth, to get the companies to invest into new products, into new people, into new practices, and expand their profitability. But if those companies are actually just using the debt either to refinance existing debt or to invest, then that isn't going to help the economy at all. And this is one of the problems that the Chinese authorities are now facing, because they've pumped out billions and billions of debt and none of it has been used for the right purpose. And in terms of what's happening in the property sector, which represents around 25% of Chinese GDP, this chart shows the year-on-year movement in both real estate loans, which are shown by the yellow line on this chart, and the total volume of mid and long-term industrial loans over the last 10 years. And what this shows is that between the start of 2014 and the end of 2016, there was a year-on-year increase in the volume of property lending, and that increase peaked at 27% at the end of 2016. However, since that time, there has been a dramatic fall in the volume of property lending, and it actually moved into negative territory in 2023. The total volume of property loans actually started to reduce. And this is as a result of the fact that the property sector in China has completely collapsed. Over the last few years, we have seen some of the major property developers, such as Evergrande, getting into financial difficulty and therefore not being able to continue trading, and they certainly haven't been able to take on more debt. And in fact, the 3 red lines that was introduced by the Chinese authorities prevented a lot of these big property companies from actually taking on more debt because they were seen to be in breach of one of those 3 red lines. And this is one of the major problems that the Chinese economy is now struggling from, because a lot of the growth in the Chinese economy between 2010 and 2021 was fueled by the growth of the property sector, and it accounted for around 25% of total Chinese GDP. This chart shows the total amount of debt being provided to households, so basically mortgages to buy property, dating back to 2017. And the pink bars on this chart show the full year figures, and the black bars the period through to April each year, so a like-for-like period. And what this shows is that between 2017 and 2021, there was huge demand for property in China, and the total level of new mortgages issued in each year rose from 5.3 trillion yuan in 2017 to 6.1 trillion in 2021. However, as I'm sure you'll be fully aware if you follow the channel, over the last 2 years there have been major problems in the Chinese property sector, and in 2022 the total level of mortgages issued fell to 2.7 trillion, so less than half of what was issued in the previous year. It fell further to 2.5 trillion in 2023, and as you can see from the black section, the level of mortgages issued so far in 2024 is less than at any point over the period back to 2017. So this tells us that demand for both property and mortgage lending over the last 2.5 years has crashed. This chart shows the ratio of government debt in China to gross domestic product, dating back to 2012. And what this chart shows is that over the last 12 years, there has been a consistent and rapid increase in the amount of debt that the Chinese government has been taking on, and the percentage of debt to GDP has increased over this period from 34.4% in 2012 to 79% in 2023. And the Chinese authorities have now announced that they are launching the sale of a further 1 trillion yuan of debt. 300 billion of this debt, so 30%, will be dated as 20-year bonds. 600 billion, so 60%, will be dated as 30-year bonds. And 100 billion, so 10%, will be dated as 50-year bonds. So these are very long-dated bonds. And what this shows us is that the Chinese government is continuing to raise more and more debt to try to stimulate the Chinese economy, to get it boosted, to try to hit that 5% target for GDP growth for 2024. But the indicators that we've talked about in today's video tell us that just throwing tons and tons of debt at the economy is starting to have less and less impact. So what's the summary and conclusion today? Well, I wanted to post this video because I think what's happening in China right now is really fascinating. Because when we're talking about the growth of an economy, generally speaking, people just look at GDP figures. And if you have a strong figure, then obviously people assume that you're doing well. And in 2023, China posted GDP growth of 5.3%, which was ahead of most of the Western economies. So you'd think, therefore, that China is doing very well. And the target for 2024 is 5%, so that looks like it's in line, broadly speaking, with last year. But when we're talking about GDP, you need to dig down into the details to look at exactly how that's been achieved. And that was really the purpose of today's video, to lift the lid and have a look at how China has been stimulating its economy. And what we've seen from the data is that the government has been using a number of different methods to try to boost its figures. The first thing that we looked at was what was happening with the stock market. And the stock market, generally speaking, is a good indication as to what's happening with all of the companies in your country, because it's an aggregate of all of those share prices. So generally speaking, if share prices are going up, then that means that those companies must be doing quite well because investors are happy to buy more of their shares. If share prices are going down, then that tells us that there might be a problem. And over the last 2.5 years, there's been a significant fall in the Chinese stock market, and that compares with rises in most markets elsewhere around the world. So the message that the stock market is telling us is that there are problems in the Chinese economy. Now, over the last couple of months, that's turned around. The stock market has bounced back again. So you might be thinking, well, that all looks good. Things have obviously turned the corner. But when you dig into the detail and see why the stock market has gone up, the main driver is because the Chinese government have been buying shares. They've been giving money to funds in order to buy shares to boost their price. So we're looking at a manipulation of the stock market. The reason that it's bounced back isn't because Chinese companies are suddenly now doing very well and the outlook is strong. It's because funds have been provided with cash and they've used that money to increase the share price. So this is an artificial adjustment to where the index was. And the other thing that the Chinese government has been doing is using large amounts of debt to provide it cheaply to companies to help to boost their growth, allowing them to have access to that capital so they can invest into more machinery, more people, and expand. And that would work generally speaking. However, what we've seen from the data from the RHODIUM research is that a large chunk of that debt has firstly been used to refinance existing debt. So that doesn't help anybody to grow. All that does is move money from one pocket to another pocket. It gets you out of a hole. If you've got your debt that's due to be repaid and you can find new debt and use that to repay the old debt, then that keeps your company alive. But it doesn't give you any net gain. You don't get to a position where you can start buying more machinery and investing into more people because all of that new debt has gone day one on paying off all of the old debt providers. So that hasn't helped to boost the economy. The other thing that it's been used for is to repay local government debt. And I'm currently working on a video that I'll be posting soon talking about the huge amount of local government debt, $9 trillion, that potentially is at risk of causing major problems in China. So please look out for that video. And then the final thing that this debt has been used for is actually by companies that have taken the debt at a very low cost and used it to make a profit. They've invested that money into the stock markets and into arbitrages where they know that they can earn higher interest than they're paying and therefore pay themselves a nice profit. But it isn't helping with the long-term growth of the economy. There's no long-term investment in that strategy. Now, the Chinese government is still looking to boost the economy through more debt. It's now announced a further $1 trillion of debt that it's raising at the central level, which it will then use to pump into the economy. But the data that we looked at the end of today's video indicates that corporates in China may actually be getting to saturation point where they can't take on any more debt. And it will be interesting to see whether or not the Chinese authorities are able to deploy that additional 1 trillion yuan of debt into the economy, or if they've just got to the point where nobody can take on any more debt. So the overall summary of today's video is that what we've seen over the last 2 years from the stock market tells us that the Chinese economy has been struggling. The performance has been poor related to other stock markets. However, the Chinese authorities have tried to turn that around by buying shares. They've also tried to turn around the performance of Chinese corporates by providing them with large amounts of cheap finance. However, it looks like that cheap finance hasn't gone to the right places in order to provide long-term growth for the economy. And that leaves a major question mark as to whether or not China will be able to achieve its 5% GDP for 2024. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.